One of the questions I'm often asked by clients is about taxation. We focus on getting your business to be the best performing business it can, but taxation affects every business. Taxation is the outcome of your profits. So what are the questions my clients ask me when it comes to planning for tax? How is my tax going to be different to last year? Businesses change, profits change, the tax environment changes, so you need to be aware of the impact of tax on your changing profits. So when your profits increase, the tax is going to increase. Also, as the pay-as-you-go installments for the following year are going to increase. When your profits reduce, it means you're most likely going to be paying less tax. And if you're paying less tax for the financial year, it means you need to make sure that you're not overpaying your installments. So we've just come out of a number of years affected by COVID, and look, the argument is many businesses still are affected by COVID, but we are seeing businesses return to profit, businesses returning to profitability. And what does that mean? Well, it means if we're returning to profit, we've been using up those accumulated tax losses over time, and we're now in a situation where we're going to have taxable profits. And taxable profits means we're going to have tax. Now, if we haven't been allowing for that tax impact on our cash flow, then we may have a bit of a nasty surprise. We also need to be careful of the double tax trap, which affects growing businesses and businesses with improving profitability. What is the double tax trap? Keep listening and watching to find out what that is. So from year to year, one of the questions we often get asked is, have the tax cuts been passed? And there's a lot of talk always about when do tax cuts apply. And in this case, we've got tax cuts applying from the beginning of 1 July 2024, but no tax cuts in the previous year, in the 2024 tax year itself. But what incentives are available and how have they changed? And that's something we need to be aware of. And sometimes incentives are announced, but they never actually become law. They never get passed, and we've got a number of situations where it's taken a year before the announced tax changes and concessions for small business have actually passed through Parliament and have effect. So we need to be careful. So when we hear about announcements of tax changes and rate changes and rebates and incentives, we need to make sure that they actually get passed before we act on them. So one common thing as well is not understanding the difference between your business, particularly if you're operating through a company, and your individual tax position. Now, your individual tax position can be linked to what's going on in your business, particularly if you're paying a salary, taking dividends, operating for a family trust, but your business should be treated always as a separate entity, and you should be making sure that your business tax is something that you understand. You understand your obligations for income tax, pay-as-you-go withholding, superannuation guarantee, anything that is like a tax. And if you don't understand those, you need to talk to your accountant and tax advisor now. Get a good grip of what your obligations are and plan for your tax liabilities. What happened to the tax incentives? Like during COVID, we had a lot of tax incentives aimed at stimulating your investment in your business, aimed at stimulating you purchasing equipment to make your business go forward, to stimulate the economy. Now, since we've come out of that, a lot of those incentives have been withdrawn. We've gone back to the pre-COVID situation, back to the minimal incentives. So the depreciation in the recent years, we've been allowed to write off assets in total and claim a tax deduction for the full cost of the asset. That's been scaled back for small business, and we currently have a cap of $20,000 that you can get the immediate deduction for. Also, a lot of the technology boosts and incentives for investing in training and technology, well, they're all disappearing. Technology boost disappeared very quickly, and the training boost finishes on 30 June 2024. So you need to be aware of the dates that these incentives apply and make sure you capitalise on them when it's appropriate for your business before the expiry date. How do you keep track of your payments for tax? Well, there are simple things here. So you have a quarterly activity statement or maybe a monthly activity statement. It depends on a couple of things. So what's the level of your wages and how much tax are you withholding from your employees? That may determine whether you're on a monthly activity statement for your wages withholding or a quarterly activity statement for your wages withholding? Do you pay your GST quarterly or monthly or even annually? So it depends on the time that you registered. If you're a small business, very little GST, then you may have chosen to do an annual option, and you'll have to submit that before you lodge your tax return each year. But generally, most small, medium businesses are using a quarterly activity statement to submit their GST. So you may choose to be on monthly, and if you're an importer and getting concessions on deferred GST on imports, then you would be having to lodge monthly. But generally most businesses lodge their GST on a quarterly basis. So that could mean that you're lodging monthly pay-as-you-go withholding and quarterly for GST. Now, if you are paying instalments of tax for your business, for your investment earnings, then you'll also be paying those on a quarterly basis, and they will be on your activity statement as well. So they are instalments based on an estimate of what your tax position is going to be for the current year that you are in. And when you lodge your tax return, you're going to get a credit for those instalments that you have paid. But we need to keep an eye on that, because you could be lured into, or you could be stuck in a situation where you are overpaying your instalments, and at the end when you lodge your return you're going to get a huge refund. Now that's not a good thing, because it means you've been paying tax, you've been making cash payments to the tax office when you didn't need to. You could have used that cash better in your business to grow your business. On the other side, if you've underestimated your taxes or you've not set aside enough, you could be stuck with a large tax problem when you lodge your tax return. So if you want to have more control over the timing and amounts of your taxation, then you need to be on top of your financial records. You need to be on top of your finances and make sure that you keep your books up to date and you understand your position. Regularly review your bank accounts, regularly review your profit and loss, and keep an idea on how much tax you should be setting aside and where you're up to. Have you been planning for those tax payments? Make sure that you are aware of the dates. Make sure you keep your books up to date and get advice from your accountant and tax advisor on a regular basis, and make sure you fully understand your obligations and how much tax you need to set aside in your bank account, in your cash flow budget, to make sure that you don't run into any trouble. So if your tax payments are making it difficult for you to operate your business, then we need to look at the underlying cause of that problem. If you are struggling to make your tax payments because you need that cash for your business, then there are a couple of issues in the underlying aspects of your business that we need to address. One of the most obvious is that you're probably operating at a loss. You're not making a profit. That could be a big issue. The other one could be, and it's very likely that we see this a lot, is that you are making sales and generating revenue, and you're incurring the costs of creating that revenue. So you'll have wages and rents and outgoings, but your customers may not have paid you. Okay, you may have incurred the cost to generate that revenue, but your customers haven't paid you. So when you come to pay the tax that you're obliged to, particularly for wages and GST, look, you may not have the cash in your account because your customers haven't paid you on time, but you've still paid out for your costs of creating the revenue. You've still paid out for your wages, you've still paid out for your rent, you've still paid out for all of those outgoings that are necessary, and maybe even you've fallen into the trap of taking money out of the business that you might have invested, but it's the wrong time because the business cannot support you taking money out. So you need to keep an eye on your cash flow, and this is where careful cash flow planning comes in, and you should be looking at this on a regular basis and monitoring how effective your cash flow is, and have you allowed for the tax payments? So one of the other things we see is business owners who are so focused on tax. Tax is the big issue for them. They want to save tax, they don't want to pay tax, they are so focused on everything that they can do to avoid paying tax, so they'll pay for deductions, but it's distracting them from the goals of why did you start your business? You went into business to make a profit. You went into business to set yourself up financially. You went into business so that you could have a lifestyle that you chose, and you need to have the business supporting that. So otherwise, if your business is not generating those things, maybe it's time to pull up stumps and go and get a job. But if you're so focused on tax, you're going to be distracted from the key things you need to be doing to run your business better. So instead of focusing on tax, focus on the things you need to be doing to grow a great business. So the double tax trap, it's a trap for these two types of businesses. The first one is a business that has just started and has begun and it's made a profit. So a typical startup business has gone and maybe it's not the first year, but it's the second year they've made a profit. It's a double tax trap. The second type of business is the one that is growing at a fast rate, or they've gone into a profit situation where they were in a loss situation before. So what is that double tax trap? Well, it is a double tax trap because you have to pay two lots of tax in a very short space of time. Now, let's have a look at this. Okay, so you've made a profit this year, but last year you didn't make a profit. Okay, or the alternative is you made a small profit last year, but you made a bigger profit this year. Okay, so what happens there is that your tax installments are based on the profit you made last year, which in the situation we're talking about is very little or not at all. So zero tax. But now you've made a profit, and let's say your profit is $100,000 and you're a company and the tax rate is 25%, then all of a sudden you've got to pay $25,000 of tax on taxable income of $100,000 when you lodge your tax return. Now, if you're an Australian small business using a registered tax agent, you may not need to lodge your return until May the following year. So that's a good thing because you've deferred paying the tax. The problem is that you now have to come up with $25,000 of tax for the year that's just gone or the year that went. Now, if you're lodging towards the end of the following year, we have a trap, and it's a big one because what has happened is the ATO will schedule your pay-as-you-go installments for the following year or the current year of tax based on your most recent tax return lodged. Now, your most recent tax return had low tax because you had low income. So you have not been paying installments of tax based on your current income. You've been paying installments based on the previous low income or zero income. So you may not have been paying any installments. So now we come to, you've just lodged your return. Let's say you've just lodged your return for 2024 or 2023. You've lodged your return for 2023 and we now have the June 2024 activity statement on which you're paying your pay-as-you-go installments for the 2024 year. And the ATO will say, hey, you should have been paying installments based on the full year. Okay, now we've estimated your taxable income for the full year is going to be another $100,000 because that's what you declared last tax return that you lodged. So your installments for the year should have been $25,000. And that June activity statement will be due, let's say, the 28th of July. But you still have $25,000 due in May of 2024, which relates to your 2023 year. So that's $25,000 there. You've also got $25,000 due based on your 2024 year pay-as-you-go installments. 2 years worth of tax within a very short space of time. We're talking 2 years worth of tax payments that you have to come up with in just 4 months. So that is a double tax trap. Then again, of course, your September activity statement for the following year, that's going to be based on your most recent tax return. So you're going to be up for another quarter of that tax. So another 3 months tax, another $7,500. So all of a sudden, you've gone from paying no tax regularly each quarter, and all of a sudden in about, let's say, that's 7 months, you're going to be paying 2.25 years worth of tax. That is a trap that we want to avoid. And that's where we've got to come in with careful cash flow and profit forecasting and understand what your tax obligations are going to be and make sure we plan for that in advance.